First, I think the U.S. did revalue it just with the accounting move. I think it would signal that the U.S. is on board with gold being moved back into the system as a neutral reserve asset, fully on board. And sort of, I think it would be bullish for gold. I don't know that we'd wake up and gold would be up, $1,000 or something, but I think it would be very bullish for gold over the ensuing however many, or over the coming quarters and years. If gold prices went much higher as part of a reset of a system where gold is the neutral reserve asset, that it might benefit the Chinese and the Russians to the detriment of others, particularly given in-ground reserves. If the Chinese and the Russians have more in-ground reserves of the neutral reserve asset, then that is an advantage, relative to what they may have in vaults. And I think there's some validity to that objection.
In a world where economic predictions often fall flat and geopolitical tensions shift like sand dunes, one asset continues to shine brighter than ever: gold. According to leading macro analyst Luke Gromen, we are not just witnessing another bull run in precious metals. We are watching a fundamental transformation of the global monetary system that could rival the significance of Nixon's 1971 decision to close the gold window. Gromen presents a compelling thesis that gold has entered what he calls a no-lose scenario across all economic and geopolitical outcomes. Whether interest rates rise or fall, fiscal crises emerge or ease, trade deals succeed or fail, or whether we see war or peace, every path appears to lead to higher gold prices. What makes this analysis particularly striking is Gromen's assertion that we are witnessing a monetary shift as significant as Nixon's 1971 gold window closure, driven by central banks quietly accumulating roughly 1,000 tons of gold annually. This steady demand has already pushed gold past the euro to become the world's second-largest reserve asset. If this pace continues, gold could surpass the dollar and U.S. Treasuries as the primary reserve asset within just a few years, representing a complete reversal of the post-1971 monetary order. The geopolitical calculus creates fascinating contradictions. While U.S. policymakers worry that higher gold prices benefit adversaries like China and Russia with significant gold reserves, rising gold prices would also serve key U.S. objectives by strengthening the yuan, rebalancing trade relationships, and boosting Chinese consumer purchasing power for American goods. Before we dive deeper into insights on gold, silver, and the shifting dynamics of the global financial system, be sure to follow this article closely and stay connected so you don't miss the latest updates and analyses.
I think for gold, I think it's a trade where all roads lead to gold. Like pretty much anything that can happen, I think is good for gold. And I think ultimately it's good for Bitcoin, but Bitcoin still trades with a risk-off component to it, as people have talked about, vis-a-vis NASDAQ and what have you, stocks more broadly. But gold seems to be kind of a winner no matter what happens. Rates go up, we get a fiscal crisis, which may be partly contributing to the breakout today. Good for gold. Rates go down aggressively, real rates go negative. Good for gold. We get a trade deal, or we don't get a trade deal. We saw that with Liberation Day. Good for gold. We get war. Good for gold. We get peace. Increasingly, it looks like the peace is going to be dictated, at least in part, by the BRICS. That's probably good for gold. Any peace dictated by BRICS rather than by the U.S. And so you kind of look around and just go, all roads lead to gold. Shortly thereafter, I think I said to someone, I think this might be come to be seen every bit as big as Nixon closing the gold window in 71. And yeah, I think it's played out quite well. Central banks have bought on average, I want to say 1,000 or 1,100 tons of gold a year every year since. Gold is now the second biggest reserve asset that just surpassed euros. Another probably, 2 years of decent price appreciation and 1,000 tons a year, and gold will be the number one reserve asset, surpassing the dollar and treasuries. And so to me, there's an absolute sea change going on since that happened, being driven by realpolitik, which is, I heard from multiple different people that don't know each other, that major Persian Gulf nations were quote unquote, scared, basically like scared to death, petrified, I think was the word, by that seizure of FX reserves. And so regardless of how you feel about the actual seizure itself, it happened and there was a reaction, and that reaction makes perfect sense. And I don't think you can put the genie back in the bottle as it relates to that. Everyone has seen that. And so I think that's done. In other words, going forward, you're going to have a neutral FX reserve asset, and that's gold. And I think on some level it can be Bitcoin. We've seen some marginal sovereign wealth fund type buying out of the Gulf. I think Abu Dhabi late last year, but that's been about it. It could hold that or complement gold in that role, but we've not really seen it yet. But that's like I said, I think that was the 1971 moment in the other direction. That was, we're going back to a system with a neutral reserve asset that floats in all currencies. And that then has just absolutely enormous implications for the global macro and global financial system, because what it implies is that currencies are going to trade more on balance of payments. And so the nations that run big deficits are going to have weaker currencies, and the nations that run big surpluses are going to strengthen relative to those that run big deficits. And that was sort of how it had always worked, kind of, except for the dollar. The dollar ran the biggest deficit, but was still the cleanest dirty dirt, or the cleanest dirty shirt. And I think we're the worst performance in the dollar in 50 years to start this year. I think might be a warm up to sort of the dollar getting marked to its balance of payments fundamentals. Well, I think if the U.S. they'll take the shorter one first. I think if the U.S. did revalue it just with the accounting move, I think it would signal that the U.S. is on board with gold being moved back into the system as a neutral reserve asset, fully on board. And sort of, I think it would be bullish for gold. I don't know that we'd wake up and gold would be up, $1,000 or something, but I think it would be very bullish for gold over the ensuing however many, or over the coming quarters and years. As it relates to China vis-a-vis gold, it's kind of a two sides of the same coin type of question, because I do believe there are interests in the U.S. government and intelligence world that see that if gold prices went much higher as part of a reset of a system where gold is the neutral reserve asset, that it might benefit the Chinese and the Russians to the detriment of others, particularly given in-ground reserves. If the Chinese and the Russians have more in-ground reserves of the neutral reserve asset, then that is an advantage, relative to what they may have in vaults. And I think there's some validity to that objection. The flip side to it is the U.S. spends most of its interactions with China telling the Chinese they need to consume more of their own production. And the Chinese government has been, paradoxically, the communists have been telling their people for 25 years to buy more gold, buy gold, buy gold, buy gold, buy gold, buy gold, which is a very non-authoritarian, decentralized, freedom-loving thing to do, which is why I say it's paradoxical. And so point being is that I think the grand bargain to be had on the table is, look, the U.S. needs to weaken the dollar. The U.S. wants the yuan stronger against the dollar, and the U.S. wants China to consume more of their own production. And as you go down that list of three, the price of gold's a lot higher. It's like check, check, check. It takes care of all three. You can recap Chinese consumer balance sheets. They will have a lot more money to spend on their own production if the price of gold goes up a lot. You will have a weaker dollar. And I forget what the third one I just said was, but the gist of it is that the price of gold going up a lot helps all three of those things. So there's sort of two sides of the house. I think from a grand deal to be had within sort of a reset, I think it is in the U.S.'s interest for the price of gold sitting in China to go up a lot. But it's not in the U.S.'s interest, arguably, for the price of gold in the ground in China and in Russia to go up a lot. So, it's kind of one of these, the U.S. needs to decide what it wants, because ultimately China's happy to keep buying gold here because they know relative to U.S. debt, it's still wildly undervalued.
While some of the most influential figures in global finance quietly hold significant gold positions, the broader financial sector remains hesitant. As Luke Gromen points out, careers are safer when losses occur in consensus trades like U.S. Treasuries than in contrarian positions such as gold. This stands in sharp contrast to central banks, which continue to accumulate gold aggressively, and to early adopters in finance who recognize the deeper implications of reserve seizures and shifting monetary dynamics. At the core of Gromen's analysis is the idea that decades of monetary distortion have left most people viewing the system upside down. Using OPEC as an illustration, he explains that the cartel exists only because oil is priced in fiat dollars. If oil were sold in gold or Bitcoin, both finite, harder forms of money, producers would already be incentivized to maximize output, eliminating the need for production caps and fostering a more productive, low-inflation world. Against this backdrop, Gromen emphasizes simplicity for the average investor. Instead of overcomplicating strategies or trying to time every market move, he suggests allocating 10 to 20% of net worth into gold and Bitcoin, adjusted for individual comfort with volatility. Once that foundation is set, investors can step back, tune out the noise of daily fluctuations, and let the long-term dynamics of harder money work in their favor. Let's return to the interview.
No, it's interesting because I was at a conference probably 18 months ago, and somebody said to me, Luke, I get you, I understand what you're saying, but if I buy gold and it goes down 30%, I lose my job, and if I buy treasuries, long-term treasuries, and they go down 30%, I keep my job. And so it's super interesting because at the same time, without getting into any specifics, I'm also having conversations with people at at very high levels in finance, very recognizable names, and they love gold. They love it, and they own it big. And so there's almost like this, sort of even like Besant, right? He's a self-admitted gold buck, right? He's now the Treasury Secretary of the United States, and yet, like most of traditional finance is still where. That person who said that to me is like, look, I can't own it because if it goes down, I get fired. Whereas if I lose money in treasuries like everybody else, then I'll keep my job. And so to me, it just speaks of being in early innings, right? It's kind of the classic, early adopter, late adopter stuff. Like the early adopters, they're partly there, but they get it, I think. And part of it is, it's not a question of intelligence or of sophistication. I don't want to make you think that's the reason for it. But I do think what it is, the average person in finance not only doesn't get paid to think about, but is actively discouraged from thinking about things like, what does it mean that central banks are buying all this gold and stuff? What does it mean Russian FX reserves being like the average financial person in America is like, oh, we seize Russian FX reserves. All right, yeah, hashtag America, great. And that's the extent of the thought, rather than, okay, what does this mean? What does this mean? And so the guys are going, what's this mean? What's this mean? What's this mean? Are going, oh my God, I got to buy gold. I got to buy gold. And the central bankers are going, oh my God, I got to buy gold. And sort of the people that aren't thinking about those second derivative things are like, well, just not thinking about that yet. Price is probably starting to wake them up to that, right? Americans, right or wrong, right? The average American investor won't buy anything if the price isn't moving. They'll wait till the price moves. And that's just how we are culturally. Certain cultures are value buyers. Certain cultures are momentum buyers. And Americans culturally are generally a momentum buyer. So, it's probably starting to get onto people's radars. But even then, most hedge fund prime brokerage agreements, I'm told, prohibit specifically being able to take physical delivery of gold from your prime broker. Right? By the time this cycle's over, I don't think that will be there still. It's fascinating because money's been so distorted for so long that everybody kind of has it upside down, which is to say, think about OPEC exists. It's a cartel, right? And why does OPEC exist? It exists to restrict the output of oil in order to maximize dollars. Why do they have to do that? Because the dollar's a fiat currency that is, you have to do that. If OPEC was selling for gold, or if OPEC was selling for Bitcoin, there would be no need for OPEC. Because every producer would be incented to run oil production full out all the time to get as much gold and Bitcoin as they could today, because it was a finite, harder money. And as a result, you would have a deflationary, highly productive, and every business around the world would have that same incentive. Maximize output and productivity today. I'm going to invest to improve productivity because I'm competing for a harder money you end up with this wonderful world, this high growth, low inflation, highly productive world just by changing the incentive like that with the money. But it's, it's like if you ask a fish, its environment, the various thing it would describe would be the water. It's one of these things too where for the average investor, it's put 10-20% of your net worth into gold and Bitcoin based on, volatility adjusted, right, with what you're comfortable with, and then like go live your life. Like it's not one of these things you need to be monitoring every day, and it's not a huge fix, right? It's not like, in a country that really really loves like, okay, just give me the pill and I'll do it, doc. Like the pill is simple. The financial pill is simple. It's 10-20% in gold and Bitcoin, volatility adjusted based on what you prefer, and like go live your life.
This perspective ties together the interplay between institutional hesitation, cultural behavior, and structural distortions in the monetary system. The reluctance of traditional finance to embrace gold reflects a system still anchored in fiat incentives, where safety lies in following consensus trades rather than anticipating change. Yet central bank accumulation and the logic of harder money point to a shift already underway. The OPEC example underscores how fiat currencies shape global decision-making, forcing producers to manage supply in ways that would not be necessary under gold or Bitcoin. Both themes converge on the same idea. As momentum builds and harder money regains prominence, incentives across finance, trade, and investment are likely to realign toward greater productivity, stability, and long-term value preservation. How might the growing role of gold as a neutral reserve asset, alongside the gradual adoption of Bitcoin, reshape global financial incentives and investment strategies in the years ahead? Stay tuned for more real, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. And if you're interested in Bitcoin-specific news, be sure to check out and subscribe to our other channel as well. Thank you for your support and enjoy the video.